The world of investment is a captivating blend of risk and potential reward. Every investor steps into this world with a shared aspiration to see their money grow. Yet, the path to financial growth is not always smooth. It is paved with an inherent trade-off. The alluring potential for higher returns often comes hand in hand with the acceptance of greater risk. This delicate balance between risk and return forms the bedrock of sound investment decisions. A prudent investor doesn't just chase the highest possible returns, they seek a level of risk that aligns with their financial goals, time horizon, and personal tolerance. Understanding this fundamental interplay is the first step towards navigating the complexities of the investment landscape. Understanding how much risk a portfolio takes is important. Two key metrics, portfolio turnover and R-squared, help us understand this. They provide a glimpse into the inner workings of investment funds and guide investors towards making informed decisions. By grasping the significance of these metrics, investors can gain valuable insight into the strategies employed by different funds and align their choices with their investment philosophy. Imagine a portfolio as a dynamic entity, a collection of investments that can be bought and sold. Portfolio turnover is a metric that captures the level of activity within this portfolio. It essentially quantifies how frequently the fund manager buys and sells securities within the fund over a specific period, typically a year. A high turnover rate suggests that the fund manager is actively trading securities, constantly adjusting the portfolio's composition in pursuit of short-term market movements. Conversely, a low turnover rate indicates a more passive approach, where the fund manager maintains a relatively stable portfolio, holding investments for the long term. Turnover is expressed as a percentage. This percentage represents the portion of the portfolio's holdings that were replaced during the year. For instance, a turnover rate of 50% implies that, on average, the fund manager replaced half of the portfolio's assets within that year. Understanding a fund's turnover rate provides valuable insights into the manager's investment style and the associated costs. Calculating portfolio turnover is a straightforward process. Let's break it down step by step. First, identify the total value of securities bought and sold. Over the specified period, usually a year, determine the total value of securities the fund manager has bought and sold. Next, determine the lower of the two values. Compare the total value of purchases and sales, and select the lower of the two values. Then, divide by the average portfolio value. Divide the lower value obtained in the previous step by the average value of the portfolio over the same period. For instance, let's say a fund had $10 million in sales and $8 million in purchases over a year, and its average portfolio value was $50 million. The turnover ratio would be lower of sales and purchases, $8 million. Turnover ratio, $8 million divided by $50 million equals 0.16, or 16%. This 16% turnover ratio suggests moderate trading activity within the fund. A fund's turnover ratio reveals a great deal about the fund manager's investment style and the potential implications for investors. High turnover ratios, generally above 80%, indicate an actively managed fund where the manager frequently adjusts the portfolio based on market trends, economic indicators, or company-specific news. The goal is to capitalize on short-term market inefficiencies and outperform the benchmark. However, this strategy carries the potential for higher returns as well as higher losses. Frequent trading leads to higher transaction costs, which can eat into the fund's overall returns. On the other hand, low turnover ratios, generally below 20%, suggest a more passive investment strategy where the manager prioritizes long-term growth and aims to minimize trading activity. Reduced trading leads to lower transaction costs, which can enhance the fund's net returns for investors. Fewer trades generally result in fewer taxable events, making low turnover funds more tax efficient, especially for investors in taxable accounts. It's important to note that neither high nor low turnover inherently guarantees superior performance. The effectiveness of each strategy depends on various factors, including market conditions, the manager's skill, and the fund's investment objectives. Investors should align their choice of funds with their risk tolerance and investment horizon. Section 5, R-squared, measuring correlation, not skill. While portfolio turnover provides insights into a fund's activity, R-squared delves into its performance relative to a benchmark. R-squared, also known as the coefficient of determination, measures the percentage of a fund's movements that can be explained by the movements of its benchmark index. In essence, R-squared quantifies the correlation between a fund's returns and the returns of the market, or a specific index it aims to track. A high R-squared value indicates a strong correlation, suggesting that the fund's performance closely mirrors the benchmark's movements. Conversely, a low R-squared value implies a weaker correlation, indicating that factors beyond the benchmark's influence are significantly impacting the fund's returns. Imagine a fund with an R-squared of 90% against the S&P 500 index. This means that 90% of the fund's movements can be explained by the S&P 500's movements. The remaining 10% might be attributed to the fund manager's stock selection, market timing decisions, or other factors specific to the fund. Section 6. Decoding R-squared, what the numbers reveal. Understanding the implications of different R-squared values is crucial for investors seeking to evaluate a fund's performance. High R-squared, generally above 85%, signifies a strong correlation. This means that the fund's performance closely tracks the benchmark. This is often observed in index funds or funds employing passive management strategies that aim to replicate a particular market index. While high R-squared can be desirable for investors seeking to match market returns, it also suggests limited potential for the fund to significantly outperform the benchmark. Now let's talk about low R-squared, generally below 70%. This indicates a weak correlation, meaning that a significant portion of the fund's returns is driven by factors other than the benchmark's movements. This is common in actively managed funds, sector-specific funds, or funds with unique investment strategies that deviate from the benchmark's composition. While a low R-squared offers the potential for higher returns, it also carries a greater risk of underperforming the benchmark. It's important to note that R-squared alone should not be the sole determinant of investment decisions. Investors should consider other factors like the fund's investment objectives, risk profile, expense ratios, and the manager's track record when making investment choices. Section 7. R-squared in action, a tool for fund selection. R-squared can be a valuable tool for investors seeking to align their portfolio with specific investment objectives. For tracking market performance, investors aiming to closely track the performance of a particular market index, such as the S&P 500, should seek index funds or ETFs with a high R-squared value, above 90%. This ensures their portfolio moves in tandem with the target index, minimizing tracking error. When evaluating active management, a lower R-squared can be acceptable, even desirable. However, investors should carefully scrutinize the fund's track record, expense ratios, and the manager's investment philosophy to determine if the potential for outperformance justifies the higher fees and potential for greater volatility. R-squared can also help investors diversify their portfolios. By including funds with different R-squared values and varying correlations to the overall market, investors can potentially reduce portfolio volatility and enhance risk-adjusted returns. Section 8. Index funds versus actively managed funds, a tale of two approaches. The concepts of portfolio turnover and R-squared highlight the fundamental differences between index funds and actively managed funds. Index funds typically have very low turnover ratios as they aim to passively track a specific market index. They only trade when the index composition changes, which is infrequent. Due to their passive tracking approach, index funds tend to have very high R-squared values, often close to 100%. This indicates a near-perfect correlation with their benchmark index. On the other hand, actively managed funds have variable turnover. Turnover ratios in actively managed funds can vary significantly, depending on the manager's style and market outlook. Some managers may trade frequently, while others maintain a more long-term perspective. R-squared values for actively managed funds can also fluctuate widely. A high R-squared suggests the manager's stock selection aligns closely with the benchmark, while a low R-squared indicates a more independent approach. The choice between index funds and actively managed funds depends on an investor's individual goals, risk tolerance, and belief in the ability of active managers to consistently outperform the market. Section 9. Empowering investment decisions. The power of understanding. In the realm of investing, knowledge is power. Understanding key metrics like portfolio turnover and R-squared empowers investors to make more informed decisions aligned with their financial goals and risk appetite. By delving into these metrics, investors gain valuable insights into a fund's investment strategy, cost structure, and potential for outperformance or alignment with a specific market index. Armed with this knowledge, investors can navigate the complexities of the investment landscape with greater confidence, selecting funds that resonate with their investment philosophy, and ultimately enhancing their chances of achieving long-term financial success. Remember, investing is a journey, not a race, and understanding the tools at your disposal can make all the difference.